Warren Buffett, the legendary investor, may be great at picking stocks, but he's not so hot on picking up digital assets. He famously dismissed Bitcoin as a worthless asset that doesn't produce anything, and even joked that he wouldn't buy all the Bitcoin in the world for $25. Yes, you heard that right, $25. That's probably enough to buy you a decent lunch, but not enough to buy any significant amount of Bitcoin. Buffett's aversion to new technologies is nothing new. He famously missed out on investing in the likes of Facebook and Google during their early stages. In fact, his friend Bill Gates once tried to convince him to invest in tech companies like Microsoft, but Buffett always declined. As a result, he missed out on many great investment opportunities, including ride-sharing giant Uber, social media platform Twitter, and electric car maker NIO. If he had invested $1,000 in NIO when it went public, he would be sitting on a profit of over $80,000 today. Despite all this, Buffett's net worth has remained over $100 million, which just goes to show that you don't have to be a tech genius to make a fortune in the stock market. But besides shunning digital assets, there's another industry that Warren Buffett has avoided like the plague: real estate. Can you believe it? Wouldn't the Oracle of Omaha want to get in on the safest investment out there? But no. The only real estate he's ever owned is the house he bought in 1958 for $31,500 in Omaha, Nebraska. That's about the same as the price of a fancy sports car today. So what gives? Why hasn't the most successful investor in history jumped on the real estate bandwagon? Does Warren know something we don't? Well, we'll answer all those questions and more. But before we delve into that, don't forget to hit that like button. No matter how much you criticize Warren Buffett's investment approach, it's a fact that he has outperformed the S&P 500 by 84% over the past 20 years, and he's considered the greatest investor of all time. He's been in the stock market for what feels like forever, and he's consistently made smart investments. Warren Buffett has a clear stance on buying a house. Only do it if you plan to stay in the same location for a long time. He even goes so far as to call a 30-year mortgage the best instrument in the world. But then why has he avoided investing in real estate all this time? Despite sitting on huge amounts of cash during the housing market crash, Buffett didn't take advantage of the situation because he knows that managing property is a full-time business, unlike investing in the stock market. While owning one property may not be a big deal, managing multiple properties requires a lot of time and effort. Even if you own a property, there's no guarantee that you'll always be able to rent it out, but you'll still have to make mortgage payments. In addition to the time and effort required to manage real estate investments, Warren Buffett has also expressed concern about the unpredictable nature of the real estate market. Unlike stocks, which can be bought and sold quickly, the real estate market requires regular maintenance, repairs, and tenant management. Let's face it, something always goes wrong, whether it's a leaky roof or a burst pipe, and these issues can quickly cut into your profits. Plus, during tough economic times, it can be difficult to find renters, leaving you with an empty property and mortgage payments to make. While real estate investment is not necessarily a bad business, it does require a significant amount of time and effort to manage. For someone like Buffett, who values his time and focuses on finding exceptional investment opportunities, the hassle of real estate investment is not worth it. However, it's worth noting that he has invested in real estate throughout his career, primarily through REITs. REITs are publicly traded funds that invest in real estate and provide a similar investment experience to stocks. Currently, Buffett has a significant stake in Store Capital Corp., a REIT that invests in real estate properties across the United States. Another reason why Buffett has avoided real estate investment is the difficulty in finding undervalued properties. To make a great investment, one must find a great business that is inaccurately priced lower than its actual worth for one reason or another. This is often possible during times of crisis or panic when people start selling, causing stock prices to plummet. Even great businesses can suffer in such situations. For example, during a period from April to June in 2022, the stock price of Apple fell by around 25%, even though the company did not suffer a drop in sales or workforce. The panic in the market drove the price down. On the other hand, real estate prices do not fluctuate as rapidly or as often as stock prices. Although real estate crashes can occur from time to time, they are less frequent, happening only once every 1 or 2 decades. Additionally, finding a great deal in real estate is more challenging because there is no real estate exchange like there is for stocks, and real estate agents are likely to snap up any great deals for themselves before others find out. Warren Buffett also notes that real estate investments are often leveraged, which adds an extra layer of risk. When you take on debt to purchase a property, you are increasing your financial risk. While leverage can amplify your returns if the market performs well, it can also magnify your losses in a downturn. This is because the more you borrow, the more you have to pay back in interest and principal, which can put you at risk of defaulting on your loan. Moreover, a downturn in the real estate market can also result in a decline in property values. If you are leveraged, this means that you may owe more on your property than it is worth. This is commonly known as being underwater or having negative equity. Under these circumstances, it can be difficult to sell your property without incurring significant losses, and you may also find it challenging to refinance your mortgage or obtain additional financing. Buffett prefers investments that are not leveraged and have a lower risk profile. By avoiding leverage, he can reduce the risk and limit his exposure to downturns in the market. This is consistent with his investment philosophy of seeking out undervalued companies with strong fundamentals rather than relying on speculative investments or market timing. While leverage can be a powerful tool for generating returns, it also comes with significant risks, which is why Buffett prefers to invest in assets that are not leveraged. Buffett made a shrewd investment in Apple by acquiring 5% of the company for $36 billion in 2018. As Apple's market value skyrocketed to $3 trillion in just a couple of years, his stake grew to $160 billion, and he also received regular dividends of about $775 million each year. This type of return on investment is difficult to replicate in the real estate market, where profits are usually slower to materialize. In fact, Buffett's investment in See's Candy, which he purchased for $25 million in 1972, has returned $1.35 billion to his company Berkshire, even after factoring in the $32 million it invested in the business over the years. This highlights the incredible potential for growth and profit in the stock market compared to real estate. Additionally, the sheer size of the stock market makes it a more lucrative option for investors, with a total value of about $93 trillion compared to the US real estate market's $3.81 trillion. While Warren Buffett has had tremendous success in various industries, he doesn't invest in real estate. He prefers investments that require less hands-on management and have higher growth potential. While real estate can generate passive income, it requires significant time and effort to manage, and its growth potential is limited. Buffett believes that there are better investment opportunities that are less risky and offer higher growth potential. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!